While making a smoothie, you decide how much of fruit goes into your smoothie and whether you're going to put in milk or curds and how much of it is going to go in, so that you land up with the end product which tastes good and tastes good for you as an investor. It may not taste good for your neighbor, but you make a smoothie which is designed and made with ingredients as per your taste. That is what asset allocation does for your investment portfolio. It helps you arrive at how much of each asset class you must be owning in your portfolio as an investor. The next question is, does asset allocation actually work? And the only way to answer it is go and test it with real market numbers and real market investments. Let's do that. Let's take the example of our savvy investor Arjun, who did his risk profiling and he got an answer that he is a growth investor. So he must be putting 30% of his money in debt and 70% of his money in equity. As on December 31st, 2019, he had a portfolio of 50 lakhs, which he divided in 15 lakhs. He put it in an HDFC income fund, which is a debt mutual fund, and 35 lakhs he invested in HDFC index fund, Nifty 50 plan, which is basically a equity fund which tracks the Nifty 50 index. 3 months after he made his investment, what do you think his portfolio will look like as on March 31st, 2020? We all know that the COVID hit the markets and there was a huge correction in the markets in the month of March. And as on March 31st, 2020, this is what his portfolio looked like. His investment in the HDFC income fund was marginally up to 15.4 lakhs, whereas his investment in the HDFC index fund, which was the equity fund, had fallen to 24.7 lakhs. So overall, his portfolio fell from an amount of 50 lakhs to 40.11 lakhs. So the next question is, what should Arjun do now? He has 3 options. 1, do nothing. Why do nothing? Because he is clueless about what he should do with his portfolio. The second option for him is to sell all his investments in the equity market because he is extremely worried about the fall in the equity markets and he decides to get out of the markets. The third option which Arjun has is to do the smartest thing, which is do a asset rebalancing. If he goes and looks at his portfolio has moved from a 30% allocation in debt and 70% allocation in equity to a 38% allocation in debt and a 62% allocation in equity, purely based on the movements in the market. But since the markets are corrected by almost 30%, he decides to do an asset rebalancing so that his portfolio comes back in sync with his standard asset allocation of 30:70. So if he were to do this allocation, obviously he needs to sell a portion of his debt and invest that into equities. And how much does he need to sell? He needs to hold a portfolio of debt which is equal to 30% of his current value of portfolio, which is 40.11 lakhs. So his target debt portfolio is 12.03 lakhs, whereas today the value of his debt portfolio is 15.4 lakhs. So what he's going to do is he's going to sell his debt investments worth 3.37 lakhs and invest them into equities. And once he does that, the value of his equity holding will go up from 24.7 lakhs to 28.08 lakhs. What is happening here is he's selling some part of his debt and buying equities, but what you should note here is he's buying equities at a much lower value. The value of HDFC index fund, which was 111 when he bought it in December and which fell to 78 in March, as on November 30th, 2020, was at a higher value of 120 per unit. This resulted in his portfolio increasing from 40.11 lakhs as on March 31st, 2020 to 56.54 lakhs as on November 30th, 2020. Individually, his equity portfolio today stood at 43.06 lakhs, whereas the value of his debt portfolio had increased to 13.48 lakhs. In terms of his asset allocation, he was invested 24% in debt and 76% in equities. To put it all together in a single chart, Arjun's portfolio moved from a value of 50 lakhs as on December 31st, 2019 all the way down to 40.11 lakhs on March 31st, 2020, and as on November 30th, after he did that asset rebalancing based on his portfolio values as on March 31st, the portfolio was up to an amount of 56.54 lakhs, which is an increase of 41% from his lows as on March 31st, 2020. While the portfolio value of Arjun after he did asset allocation and resulted in a portfolio of 56.54 lakhs looks really good as on November 30th, 2020, you will be able to appreciate its importance better if you were to compare this with if Arjun had not taken any action as on March 31st, 2020. If you look at the value of his portfolio, if Arjun had not done anything, as on 30th November, he would land up with a portfolio value of 55.55 lakhs. When Arjun did asset allocation, he resulted in a portfolio value of 56.54 lakhs, which was higher than the portfolio value of 55.15 lakhs when he did nothing by an amount of 1.4 lakhs. That means Arjun earned a return, or the gains that he made by doing asset allocations were higher by 9% compared to him not doing anything. Making a return of 9% by doing asset allocation compared to not doing anything is a fantastic return to be earned in a short span of 8 months. Now imagine if you were to constantly do this as and when you see movements in the market, what is the kind of returns you can realize by following your standard asset allocation. While these returns of 1.4 lakhs are fantastic, what if I told you that Arjun could do much better? Now your question is, how is that possible? And the answer to that is strategic asset allocation. If you go back to our previous session wherein we talked about strategic asset allocation being a purposeful deviation from your standard asset allocation so that you could take advantage of extreme market conditions. Let's run this through with our example of what happened in March 2020. If you look at the portfolio of Arjun, his standard allocation was 30:70, and as per his strategic asset allocation, he decided that it was a very good time to own equities because they had corrected quite a bit in a span of less than 4 weeks, and he decided to deploy strategic asset allocation, and instead of moving his portfolio to his standard allocation of 30:70, he decided to move it to a ratio of 20% debt and 80% equity. Consequently, 40.1 lakhs multiplied by 20%, which is 8.02 lakhs, is the amount of money he decided to keep in debt. And to achieve that, he had to sell debt worth 7.38 lakhs and he invested that amount into equities. So as on March 31st, he held a portfolio of 40.11 lakhs, which is divided as 20% in debt and 80% in equities. Now, what did his portfolio look like as on November 30th, 2020? At a portfolio value of 58.2 lakhs, after he deployed strategic asset allocation, Arjun is sitting on a gain of 3 lakhs compared to a portfolio when Arjun would have done nothing as on March 31st, 2020. By earning a return of more than 3 lakhs by deploying strategic asset allocation, Arjun earned a return of 20% higher than he would have earned when he did nothing. So if you were to stack up all the 3 options, Arjun makes a gain of close to 1.4 lakhs when he deploys standard asset allocation and a gain of 3.05 lakhs when he deploys strategic asset allocation, which translates into a return of 9% higher returns in standard asset allocation and 20% higher returns in strategic asset allocation compared to not doing anything when markets present you with an opportunity. As it is said, the proof of the pudding is in the eating. So we've seen here how an investment into real assets, which were, and 2 examples we picked up of an SDFC equity fund and an SDFC debt fund, and when we aligned them to how the markets moved and what you should have done or responded as an investor when you know what asset allocation is, you actually are landing up with handsome gains at the end of the day. Even after you've understood the benefits of asset allocation, it is entirely possible that you may not have the time to actually track this on a regular basis and rebalance your portfolio on your own. And when you can't do this on your own, that is when you fall back to our time and tested mutual funds. In module 2 of the course, we've seen the various kinds of mutual funds and how you can get exposure to the different asset classes by being invested in these mutual funds. Similarly, there is a category of mutual funds which are known as hybrid funds, which will invest in multiple asset classes by buying or holding a single fund. If you look at the different types of hybrid mutual funds available, there are the conservative hybrid mutual funds which allocate 75 to 90% of your money in debt and 10 to 25% of your money in equity. Then there are balanced hybrid funds which can go up to 40 to 60% of your money in debt and the balance 40 to 60% of your money in equity. Aggressive hybrid funds are those which will invest a minimum of 65% of your money in equities going up to 80% and the balance is in debt. Now, by owning any of these hybrid mutual funds, you are owning a combination of debt and equity by holding a single fund. So instead of holding multiple funds, you can own a single fund and own this combination of debt and equity, wherein the fund manager would do a rebalancing between the amount of debt or amount of equity he holds based on what he thinks the markets are. If he finds the markets are expensive, the equity markets are expensive, he will reduce his holding in equities. And if he thinks the equity markets are cheap, he will go and buy more of those equities. If you look at any of the fact sheets of these hybrid funds, they will clearly state the minimum amount that they will hold in equity and the maximum amount that they would hold in equity, and similarly for debt. Now, to take advantage of asset allocation, which we've discussed till now, a category of funds which does that extremely well is the dynamic asset allocation funds. These are funds that dynamically manage how much money is invested in debt and equity based on whether they think the markets are cheap or the markets are expensive. And the last category of hybrid funds is your multi-asset funds, which invest not just in equity and debt, which also invest in gold, so that you have a exposure to 3 asset classes by owning a single mutual fund. Let's look at a couple of the hybrid mutual funds so that we can understand how these funds work and how they can do asset allocation for you if you cannot manage it directly on your own. If we take the example of ICICI Balanced Advantage Fund, which is a balanced hybrid mutual fund, at any point in time, the fund would have 30 to 80% of its investments in equity, and the amount that they will invest in equity is a function of the price to book value. Now, there are number of ways in which the funds would decide how much they must invest in. There would be a number of technical parameters which basically act as trigger points for these mutual funds to decide how much of money gets into equities and how much of the money gets into debt. As per its fact sheet, the ICICI approved Balanced Advantage Fund would invest in equities by holding large and mid-cap stocks, and it would invest in debt by holding AAA rated and sovereign bonds. Given that the fund can invest up to 80% of its investments in equities, it is a moderately high risk fund, and that can be seen through the risk meter of the ICICI approved Balanced Advantage Fund. If you look at the performance of this fund, as on 31st December 2019, if you had invested your entire 50 lakhs in this fund, as on March 31st, your investment value would have fallen to 40.02 lakhs. And as on 30th November, the value of your investments would have gone up to 53.65 lakhs. So you can see here that without you having to move your money between debt and equity, when you put it in a hybrid fund, the fund manager does that for you, and that allows you to take advantage of asset allocation without you having to do anything directly. Similarly, if you pick up another fund by the name of DSP Dynamic Asset Allocation Fund, as on December 31st, 2019, an amount of 50 lakhs invested in that fund was allocated between equity and debt in the ratio of 30:70. That means the fund had exposure of 30% into equities and almost 70% into cash and cash equivalents and debt products, which basically tells about the call the fund manager made thinking that equities were expensive as on December 31st, 2019. Because of which, when the market corrected as on March 31st, the value of your investments in this fund would have reduced from 50 lakhs to 42.93 lakhs. you can see here the losses that you make in this fund are lesser than our original example of the losses Arjun made, because the fund was already holding a large amount of cash and cash equivalents. It was not invested 100% into equities. As on March 31st, after the markets corrected, if you go back and look at the portfolio of this fund, the fund increased its allocation to equities from 30% to 67%. Now this increase in allocation was again based on a number of parameters the fund tracks, and as per those parameters, the fund would have seen that equities are cheap today and they increased the allocation to equities up to 67% as on March 31st, 2020. And obviously this increase in allocation would have benefited the fund. When you look at the value of the fund as on November 30th, it had increased to 55.17 lakhs, which is because of the increased allocation of equities in the month of March when equities were available at a low value. So you can see that if you cannot do asset allocation directly, if you cannot manage your portfolio directly, you can always outsource that to mutual funds, and the mutual funds also would do asset allocation based on their stated objective. While some funds would vary their allocation to debt and equity within a short range, some funds would vary their allocation widely, allowing them to go overboard on equities when they think equities are cheap. By now you will agree with me that asset allocation works, and it is more important for you to decide or take a call on whether you must be invested in debt or in equity at a point in time than to figure out which equity share you must have. Because when the markets fall, however good the equity share is, your investment is going to be in red. But by being in the right asset class, whereas debt or equity, you will be able to make a good amount of money that you would lose out if you do not follow your asset allocation properly. If you can do your asset allocation directly, that is a fantastic thing. If you think you cannot manage your asset allocation regularly, you can always outsource it to some of the dynamically managed mutual funds who would do the asset allocation on your behalf. Finally, you can look at strategic asset allocation as an additional strategy, but that is something which is only for the high risk, high return investors and somebody who is a little bit savvy with respect to managing his investments. With this, we'll call it a wrap on the entire discussion on asset allocation and move to the all important setting of goals in our next session.